Hello everyone, I'm Zhaobo from Group 10. You can call me Boca. Today, along with my teammates Jaden, Farooq, Muaz, and Ahmed, we'll present a comparative analysis of the financial health of Tiger Company and Lion Company. Our presentation is structured into 6 key sections, and I'll start with the introduction. In today's highly competitive market, a company's financial health is absolutely important. This report focuses on two industry leaders, Tiger and Lion, and compares their performance across 5 dimensions: liquidity, solvency, efficiency, profitability, and market valuation. Our goal is to answer one key question: which company is a better investment choice? To ensure a comprehensive evaluation, we use two core methods. Vertical analysis. By converting financial statements into percentage, we highlight structural differences. For example, Lion's cost of goods sold, which is 71.9% of sales, is lower than Tiger's 73.8%, suggesting better cost control. The second one is financial ratios. Metrics like the current ratio and the ROE quantify operational efficiency and risk exposure. With this framework in mind, let's dive into details. Next, Jaden will take over to analyze the liquidity performance of both companies.
I'm Wenhao and I'm going to do liquidity analysis. Liquidity analysis is essential to understanding whether a business can meet its short-term financial obligation using its current assets. To assess this, we use three key financial indicators: working capital, current ratio, and asset test ratio. First, working capital is calculated by minusing current liability from current assets. Basically, it shows how much the company has left over after paying off what it's owed in the short term. If the number is positive, it means the business has enough cushion to keep things running smoothly, like paying employees, suppliers, and handling unexpected expenses. Second, the current ratio compares a company's current assets to its current liabilities. This tells us how many dollars of current assets are available to cover each dollar of short-term debt. It is one of the most widely used indicators of liquidity. Third, we have the asset test ratio, also known as the quick ratio. This is a stricter version of the current ratio. It removes inventory from the asset calculation and includes only cash, short-term investment, and the receivables. This ratio shows how well a company can meet immediate obligation without relying on inventory sales. These three formulas provide a strong foundation for evaluating a company's short-term financial health and operational efficiency. Now, let's move on to interpreting the three indicators and what their value can tell us. Starting with working capital. If value is positive, it means the company has more current assets than current liabilities, which is generally good. It supports day-to-day operation and provides room for growth. However, negative working capital may indicate cash flow issue and an inability to meet short-term obligations. If the working capital is too high, it might reflect inefficiency, as excess resources are not being used productively. Next is current ratio. If the ratio is below 1, that is a red flag. It suggests that the company may not be able to meet its short-term liabilities. A ratio between 1 and 2 is typically considered healthy and balanced. A value above 2 can mean strong liquidity, but it may also suggest the company is holding on to too many idle assets. Lastly, the asset test ratio offers a tighter view of liquidity. A ratio of 1 or higher is good. It means the company can cover its immediate liability without having to sell its inventory. A ratio below 1 may point to short-term financial risk and over-reliance on inventory turnover. Together, these interpretations help us understand not just whether a company can pay its bill, but also how efficiently it is managing its liquid assets. Let's now apply these liquidity measures to compare Tiger Company and Lion Company. First, both companies have current ratio greater than 2, which reflects strong short-term financial health. Specifically, Tiger has a ratio of 2.27 while Lion has a 2.15. Although both are healthy, Tiger holds a slight advantage, indicating better flexibility in converting liability with its assets. When we look at working capital, Tiger again leads slightly, with $114,700 compared to Lion's $111,100. Both values are positive, which means both companies have enough current assets to support their short-term obligations and operating needs. Again, Tigers show a small edge. As for the acid test ratio, both Tiger and Lion have an identical value of 1.2. This means both companies can meet their immediate liability without relying on inventory sales. The value matches industry benchmarks and confirms that both companies are financially sound in the short term. According to the research, a current ratio between 1.5 and 2.5 is considered healthy. Since both companies fall within or slightly above this range, we can confidently say they are in good financial shape. In conclusion, both Tiger and Lion are liquid and financially stable, but Tiger demonstrates a slight advantage in both working capital and current ratio, giving it a marginally stronger liquidity position. That's all for liquidity, and now I will give the floor to Farooq.
Hello everyone, this is Hafiz Farooq Khawar, and first of all I would like to say thank you to Mr. Jaden. He provided us with liquidity analysis. Now I'll be covering the solvency analysis part, where we will be comparing both companies side by side. So what is a solvency analysis? A solvency analysis is which evaluates a company's ability to meet its long-term financial obligations and maintain financial stability over time. So these are the ratios that I'm going to discuss with you today: debt ratio, debt to equity ratio, and times interest earned ratio. First of all, let's begin with debt ratio. Debt ratio is calculated as total liabilities divided by total assets. So this ratio shows what portions of a company's assets is defined and financed by debt. A lower debt ratio indicates lower financial risks. So if we compare the both companies, Tigers and Lions, Tigers company debt ratio is 48.02% and Lions is 41.33%. So what does it tell us? It tells us that Lion relies less on debt and has more conservative capital structure, making it less vulnerable to financial distress. So now we know about the debt ratio. Let's move on to debt to equity ratio, which is calculated as total liabilities divided by total equity. This ratio reflects debt how much debt a company uses to finance its operations compared to equity. So in order to compare these two, we need to look into their ratios. And Tiger's ratio is 92.40%, while Lions is significantly lower at 70.46. Now, if we compare these two ratios, a lower debt to equity ratio, like Lions is, which is generally preferred by investors because it suggests a more balanced and stable financing approach. Now moving on to times interest earned ratio, it measures a company's ability to meet its interest obligations from its earnings. It is calculated as EBIT divided by interest expense. Now Tiger's TIE is 7.70 and Lions is slightly lower at 7.02%. Now, although there is not much of a gap, but both companies can comfortably cover their interest expenses, but Tigers holds a slight edge here in terms of interest coverage. Now, if we compare, like there's a table over there, and if you compare like uh, from the table, we can say that Lions company is more solvent. And why is that? Because it has a lower debt ratio of 41.33% and lower debt to equity ratio, which is 70.46%. These matrices indicate a more conservative capital structure and lower reliance on debt. As according to Wild Subramaniam and Halsey, a debt to equity ratio below 1.0 signifies greater stability and lower sensitivity to interest rate fluctuations. So, however, overall, Lions Company is more solvent because despite Tiger's marginally better interest rate coverage, Lions' lower debt ratios reduce long-term financial risks and enhances stability. So, in conclusion, Lions Company stands out with stronger solvency. It has more conservative capital structure, lower reliance on debt, and is therefore less exposed to financial risks. This makes Lion a safer and more stable long-term investment. So I'm done with this part, and now Muaz will tell you guys about the efficiency analysis. Thank you so much, guys.
Hi everyone, thank you Farooq. I'm Muaz Ahmed and I will analyze the operational efficiency of Line and Tiger companies through three key metrics. Basically, efficiency analysis measure how well companies convert their resources like inventory and equipment into sales and profits. So it answers critical questions like how fast do they sell products and how quickly do they collect payments. Here we are gonna focus on three vital ratios. That is account receivable turnover that shows how fast customers pay. Then comes inventory turnover. It shows how quickly products sell. And last but not the least, total asset turnover that means how effectively asset generates revenue. So these metrics form our comparison framework. The number in table show that with 8.74 accounts receivable turnover, Line collects payment faster than Tiger. So faster collection payment means more available cash. That is a clear efficiency advantage for Line company. Then talking about the second key metric, that is inventory turnover. The Line company sell its inventory 5.91 times per year compared to Tiger, where it is 3.03. So higher turnover means less money tied up in unsold goods. It means ball has moved into line score. Then comes total asset turnover, which means asset utilization. This show how effectively each company uses its factories, equipment, and properties. Here again, Line generates higher sales for every dollar invested in its assets. Thus, efficiency analysis shows that Line outperforms Tiger in all three areas. As well as these efficiency differences impact real business outcomes and shows that line companies collects receivable and sell inventory faster and it utilizes assets more effectively to generate revenue by reducing costs and enhance profitability. These findings align with Brigham and Dawes research. In summary, our ratio analysis reveals meaningful operational difference and prove that line operates more efficiently, demonstrating stronger operational management and resource utilization. Thank you for watching. This concludes our efficiency analysis presentation. Now for profitability analysis, over to Ahmed. Thank you.
Thank you so much, Muaz. Hi everyone, this is Ahmad Hussain, and I will be now discussing two crucial sections of our financial analysis. One is profitability analysis, and another one is market performance. Here we will be comparing two companies, one is Tiger and another one is Lion. Let's begin with the profitability analysis. Profitability ratios help us understand how well a company generates earning relative to its sales, assets, and shareholders' equity. The main matrices that we will be used here are gross profit margin, net profit margin, return on assets, and return on equity. Now I will briefly explain these four matrices one by one. Gross profit margin, which measures cost control and pricing efficiency. Net profit margin, showing how much of the revenue becomes actual profit after expenses and taxes. Return on assets indicating how effectively a company uses its assets. Return on equity measuring how well a company uses shareholders' fund to generate profit. Now I will move to the second slide. So in all these four indicators, Lion Company basically outperforms the Tiger. A high gross profit margin suggests that Lion manages its production and sources cost more effectively. A stronger net profit margin shows Line is better at converting revenue into real earnings. Both return on assets and return on equity are higher for Line, proving it uses both assets and equity more effective to generate returns. As Pennam notes, high return on assets and return on equity are strong signs of operational excellence and strategic effectiveness. Basically, the line company demonstrate greater profitability, meaning stronger earnings, better cost control, and more effective use of its resources. Now I will move to the next slide. That is basically market analysis. In market analysis, basically we focus on two key matrices, the price to earning ratio and dividend yield. The price to earning ratio indicates how much investors are willing to pay per dollar of earning. A high PE reflects growth expectations, while a lower price to earning ratio may indicate undervaluation. The dividend yield show the income investors earn relative to the share price. Tiger has a higher PE ratio, which may suggest market optimism, but this doesn't necessarily mean Tiger is the better investment. In fact, Lion's stronger financial fundamentals and lower PE could signal undervaluation and potential for stock price growth. As Damodaran explains, companies with low PE ratio and high profitability often present better long-term investment opportunities. Both companies offer a dividend yield of 6%, but Lions is supported by better profitability, making it more sustainable and suitable. So in conclusion, Lion not only delivers higher earnings and returns, but also presents a better market value proposition. It combines superior performance with reasonable valuation, making it more attractive and balanced investment option.
Thank you, Ahmed. Now let's take a comprehensive look at the various indicators of the two companies as a whole. First, Line shows it is more efficient in receivables, inventory, and asset utilization. This allows it to convert resources into cash faster, resulting in a shorter cash cycle and more agile operations. Second, Line has higher profitability. It generates more revenue per dollar of sales, assets, and equity. This means it returns more earnings, which can be used for reinvestment or paid as a dividend. Third, Line is financially more stable. With lower debt and debt-to-equity ratios, it faces less risk from interest rate changes and is more resilient in economic downturns. Fourth, Line appears to be undervalued by the market. Its PE ratio is lower than Tiger's, despite stronger performance. This suggests potential for stock price growth in the future. Lastly, both companies have the same dividend yield of 6%. However, Line offers the same return, plus the benefit of better efficiency and growth potential. In conclusion, based on our financial analysis, Line Company is the better investment. Line outperforms Tiger in 4 out of 5 areas. This means that investing in Lion provides investors with strong returns, low risk, and greater long-term value. Therefore, we recommend Lion Company as the superior investment opportunity. And all data and quotes are sourced from those references. Thanks for watching.